Okay, so this is the mock exam session 1 is talking about the manufacturing account. And the question explains there's a trial balance in the question and it asks us to prepare the manufacturing account of that company. So, but the first thing we need to do is to reconcile the figures from the trial balance and the additional information. That is why you see we put A1, A2, A3, A4, A5. That is to give you an idea that there is adjustment number 1, adjustment number 2, number 3, number 4, just like that. Now, the first adjustment we make is adjustment on interest on debenture. It shows that the last date that interest on debenture was paid was on the 1st of April for that year. And the amount of debenture payable is 180,000. And then the extra information said you should make 12% provision for interest on debenture due. So what we do usually is to take the amount payable times the percentage and the duration. So since it was paid on the 1st of April, we have to reverse it back to the 31st of March. So from March to December, it gives us 9 months. That is why you see it is 180 times 12% times the duration. So if you do that, it means the percentage of the debenture due is 16,200. That is the first adjustment. Then the second is adjustment on wages. The adjustment on wages, it says it gives us a single wages, which is like the factory wages. Then it said in the additional information that 75% of this the factory wages should be shared to direct wages, while 25% should be shared on indirect wages. What's the difference between the two? Direct wages are those wages paid for labor that is directly related to the production of the product. Like for example, factory workers who are inside the factory carrying out the production. Those ones are called factory wages. Then they are called direct wages. Indirect wages are wages paid to supervisors who supervises those who are in the process. So they usually separate them when it comes to manufacturing account. So here when we separate this, it shows that from this factory wages, direct wages is 62,700, while indirect wages is 20,900. So we label it A2. Then the next is factory insurance. The amount of insurance that was slated to be paid is 19,300. But the last date that insurance was paid was in March 31st. So we have to look for the duration to know how much was paid and how much is left. Because when you do that, it means there is an amount that is prepaid that is ahead. So it gives us 14,475. This is the amount that was used to pay insurance. So if you want to know the amount that is prepaid or that is due, you have to take 19,300 minus this to give you the amount that is due for insurance. So that is that. Then we come to bad debts. I've always said bad debts are those debts that has no prospect of recovery. It means there is no way you can recover them. There is usually a provision made by every business at the beginning of the year for bad debts. But at the end of the day, the actual bad debts are calculated. If the actual bad debts are more than the provision, it is calculated as expenditure. And if the actual bad debt is less than the provision made before, it is calculated as income. So here the amount for debtors is 43,600. The provision made for bad debt was 16, and they said and the additional information that 4% should be made for bad debts as provision. So we take the debtors divided by the percentage times the percentage, it gives us 1,740. But the original provision was 16, so it means we have to take 1,744 minus 16 to give us the actual bad debt, which is $144. So these are the actual bad debt. This is entered in the profit and loss account as expenditures. Then the last adjustment I made is depreciation value for assets. This, you can be given the cost of the asset and you can be given the net book value of the asset. Net book value means the asset has been used formally and the value has dropped. So they will always put the original cost and then they will put the net book value. But when you look at the additional information, you always know what they demand from you. So here they say factory building should be calculated on the cost of the asset. So it's 2%. This is the cost of the asset. 2% is 11,500. Then the plant and equipment is on the cost 6%, which is 30,000. While the delivery truck is on the book value of it, so it's 13,000. So when we do this adjustment, then we come to have the first phase of the establishment of the manufacturing account. Now, the manufacturing account has two sections. It has what they call the prime cost and the overhead cost. Prime costs are those costs that are directly related to the production of the product or the manufacturing of the product, while overhead costs are those additional costs that assist in the production of that product. So it shows that the opening stock is this. So when you move from here, opening stock, purchases, and purchase return, closing stock, it means cost of raw materials, which is direct cost, is to 273,400. Then we look at the direct expenses of the process. It shows that direct wages is this, and then direct expenses is this. So when you put this together, it will give you prime cost. This is a cost that is directly related to the production of that product or that industry. So we look at the overhead cost, which is the next, because normally the factory cost is the prime cost plus the overhead cost. So the factory cost, the factory heat and light, insurance, supervisors, building and plant equipment, these depreciations. We take them and feed them here. So when we do that, it gives us 103,675. So when we put them together, it means the factory cost for that industry is 455,675. So, but there is something we need to add in order for it to give us the value. We'll continue.